Good afternoon, ladies and gentlemen. Welcome to another lesson for FAC2602. We are busy with our exam preparation for the supplementary examination paper that will be written on the 23rd of January. So we have one more week to prepare for that exam paper. So in the previous lesson, we have worked through question 1 of the September-November 2021 examination paper that addressed the pro forma consolidation journal entries. In today's lesson, we will focus on the group financial statements of the Grazing Ltd Group. This question counted a total of 56 marks and we are allocated a time limit of 67 minutes. So from the moment that you start reading through the information, right up until you make the last adjustment, it should take you just over an hour's time to complete the question. And please keep in mind that this time limit is subject or determined by your required section. So if we go to the required section for this question, and you should do this before you even start with the question itself. You always go to the required section first. All right. We are asked to prepare the following consolidated financial statements of the Grazing Ltd Group for the year ended 31 March 2020 after taking the above mentioned information into account. The consolidated statement of profit or loss and other comprehensive income, which is the most popular statement that they ask in FAC2602. So please ensure that you are able to draft this statement in full, especially the bottom section, that being the total comprehensive income that is attributable to owners of the parent as well as non-controlling interests. And then the second part of this question requires us to draft the consolidated statement of financial position also in full. So for this question, we do not need to draft the consolidated statement of changes in equity. All right. So it is very important that you take note of your required section in the examination on the 23rd. Only draft those statements or parts of the statements that have been stated in the required section. Right. However, in order to ensure thorough exam preparation, I will be drafting all three statements in full in this lesson so that you can practice drafting each statement in full and that you can apply the principles correctly. All right, just making sure that it is recording. All right, our please note section states that our answer should comply with the requirements of IFRS. We need to show all calculations, round off all amounts to the nearest rand, ignore the taxation effect of unrealized profits and or losses as well as capital gains tax. This one will be dealt with or addressed in the FAC2764 module, so the Financial Accounting 3 module. So in FAC2602, when drafting the group's financial statements, we may assume that there will be no change in the income tax expense for both companies. All right. And then we do not need to provide notes to the consolidated statements of the group, okay, or the consolidated financial statements, that being the financial statements of the group itself. Okay, it's not like FAC2601 where you need to provide certain notes to a single company's financial statements. Okay, for this question, we only need to draft the required financial statements for the group. We do not have to provide additional notes. However, you need to keep in mind that notes do form part of a company's financial statements as well as a group's financial statements. All right, let's start reading the information. So the information below represents the separate trial balances of Grazing Ltd and its subsidiary Econ Cows Ltd as at the 31st of March 2020. So it is clear that Grazing Ltd is the parent. Another way that you could have determined this is by studying your required section. The group is named after the parent, so Grazing Ltd is the parent in this question, and Econ Cows Ltd is the subsidiary for question 2. All right, in FAC2602, we are only concerned with simple groups. So in such groups, there will only be one parent and one subsidiary. Okay, in Financial Accounting 3, you will be dealing with complex groups. So those are groups that can have multiple subsidiaries that are controlled by the same parent. Right? Then our current financial year has ended on the 31st of March 2020, which means that it started on the 1st of April 2019. Please indicate your current financial year, because then you will be able to determine if the group was formed in a previous period or if the group was formed in the current year. If the group was formed in the current financial year, you will need to calculate a pre- and post-acquisition profit for the subsidiary. In this case, it will be Consolidated Ltd. The pre-acquisition profit will be part of the calculation of the retained earnings balance for the subsidiary at the date of acquisition. So if the group was formed within this year, the pre-acquisition profit will be part of the calculation of this amount right here. Okay. And then the post-acquisition profit will form part of the group's profits for the current year and will thus not be eliminated. Okay, whereas the pre-acquisition profit will eventually be eliminated because it forms part of the retained earnings balance at acquisition, which will be eliminated against owner's equity at the date of acquisition. All right? It's very important that you understand those principles. All right? If we look at our given trial balances, the parents' figures are listed first, and then those of the subsidiary. So what we are specifically looking for before we start with additional information is the investment in subsidiary line item. And you will find that item right here, the investment in Consolidated Ltd, which is 1.25 million. In FAC2602, we will assume that the cost price of the investment is equal to its fair value. So there has not been any change in the fair value of the investment since the date of acquisition. So we will enter this amount as the consideration received from Grazing Ltd in our analysis of owner's equity. So in that calculation, you will enter 1.25 million in this line right here. Consideration at NCI. At acquisition, the parent has paid 1.25 million for its investment in Consolidated Ltd. And since we have, let me just correct that. And since we have already entered this amount as part of our calculations, we could just cross it out. All right. There is not even enough information at this stage for us to determine the percentage interest of the parent in the subsidiary. All right. That will be given in additional information point 1, which says the following. Grazing Ltd is a farming company and sells cattle and beef meat products in Limpopo. Right? An outbreak of the foot and mouth disease has led to the acquisition of a company in the Free State. All right, so the parent operates in Limpopo, whereas the subsidiary operates in the Free State. Okay? On the 31st of July 2018, Grazing Ltd acquired 70% of Consolidated Ltd. All right? So 31 July 2018 is the date of acquisition, the date on which the group was formed, because that is the date on which Grazing Ltd obtained control over Consolidated Ltd. And if we compare this date to our current financial year, it is clear that the group was formed in a previous year or in a previous period. So therefore, the calculation of a pre- and post-acquisition profit for the subsidiary is not necessary in this question, because the group was not formed in the current financial year. Grazing Ltd acquired 70% of Consolidated Ltd, so therefore the parent's percentage interest in Consolidated Ltd is 70. All right, so this percentage has been given, no calculation necessary. Grazing Ltd will have a 70% share in the ordinary equity of the subsidiary, which means that your NCI will take up the remaining 30%. And you should have noticed in this question, or from the balances given, that preference share capital is not applicable in this question. So we will only be dealing with ordinary share capital in this question, which means that we can ignore this analysis of owner's equity. Okay, the analysis of owner's equity of preference share capital can be ignored for this question. We will only have one analysis of owner's equity calculation for this question, because preference shares have not been issued by the subsidiary. Now, at the date of acquisition, the retained earnings of Consolidated Ltd, the subsidiary, was 452,000. So we will enter that in the at acquisition section. Right, retained earnings 452, and the revaluation surplus amounted to 550,000 on the date of acquisition. Okay. Right. You will notice that they do not provide the balance for share capital or ordinary share capital for Econcals Limited at the date of acquisition. All right. Now, for FAC2602, okay, we will assume that there was no change in the ordinary share capital of the subsidiary since the date of acquisition, which means that the year-end balance that is provided for ordinary share capital, which is 650,000 for Econcals Limited, we can take that balance as having been the balance at the date of acquisition, because we assume that there was no change in the ordinary share capital of the subsidiary after the date of acquisition. So the balance at year end was also the balance at acquisition. So we will enter 650,000 in the at acquisition section. All right, this assumption that I've used is also confirmed in additional information point 7, which says that the issued share capital of both companies remained unchanged since acquisition. All right, and we may assume that each ordinary share carries one vote and that voting rights alone determine control. So in your analysis of owner's equity of ordinary share capital, this percentage right here for the parent must exceed 50% for the purposes of this module. All right, for preference share capital, it can be any percentage. Okay, but for ordinary share capital, the parent must possess a majority of the ordinary shares of the subsidiary in order to have control, because only if the parent has control over the subsidiary is the group actually formed. Okay, and because the issued share capital of the parent also did not change since the date of acquisition, we will also take this closing balance of 735,000 as the opening balance for this year. Okay, because there has not been a change in the ordinary share capital of the parent since the date of acquisition. So the year-end balance is also the opening balance for this year for the parent, and this will be the opening balance for the share capital column in the consolidated statement of changes in equity. So the balance as at the 1st of April 2019 for share capital, if you want to be more specific, ordinary share capital for the group is only that of the parent. Okay, 735,000, because the share capital of the subsidiary will be eliminated at acquisition. All right. Okay, so we have entered the equity balances at acquisition in the analysis of owner's equity calculation. We have determined our date of acquisition as well as the percentage interest of the parent in the subsidiary's ordinary equity. All right, nothing further that we can do from additional information point 1. Let us proceed to additional information point 2, which says that Econcals Limited, the subsidiary, revalued land on the 30th of March 2020, so just before the end of this year, for the first time since the acquisition date. So since the date of acquisition, there was only one revaluation in the subsidiary's records. All right, and that revaluation occurred within the current financial year. Now, the carrying amount of all assets and liabilities of Econcals Limited were deemed to be equal to their fair respective values, or to their respective fair values at acquisition, which means that we do not have to amend our balances at acquisition. Okay, we take them as is. All right. It is the policy of the group to revalue land every 2 years, and Grazing Ltd did not have a revaluation during the current year. Okay, so for additional information point 2, we need to calculate the current year's revaluation surplus for the subsidiary. Okay, and there was only one revaluation after the date of acquisition, which means that in order for us to calculate the current year's revaluation surplus for the subsidiary, we will only take the year-end balance of 945,000 and we will subtract the balance of revaluation surplus at the date of acquisition, which was 550,000. That is according to additional information point 1. All right. And once again, we need to show this in the current year section because it occurred within the current financial year and it pertains to the subsidiary. So we have to include this in the analysis of owner's equity. You should arrive at an amount of 395,000, of which 276,500 is attributable to owners of the parent and 118,500 is attributable to non-controlling interests. All right. So in addition to this, we need to show this amount in the consolidated statement of profit or loss and other comprehensive income because it forms part of the group for the current year. So we will show that in the other comprehensive income section. Revaluation surplus according to calculation 1, which is for the purposes of this lesson, the analysis of owner's equity. However, it does not need to be your first calculation. So according to calculation 1, the current year's revaluation surplus for the group is 395,000. According to additional information point 2, the parent did not have a revaluation during the current year. So this was the only revaluation for the group for the current year. So the total of your other comprehensive income section should amount to 395,000. Okay. And then we need to show these two respective amounts in the consolidated statement of changes in equity. We will show this amount that is attributable to owners of the parent in the revaluation surplus column, and we will show the 118,500 as part of the NCI column. So in that consolidated financial statement, in the revaluation surplus column, total comprehensive income for the year, other comprehensive income attributable to the parent is 276,500, and for the non-controlling interest it would be 118,500. Okay, please make sure that this amount corresponds to the amount that you have shown here. Okay, these two should be the same. All right. So we just calculated the current year's revaluation surplus for the subsidiary by taking the year-end balance of 945 and then subtracting the balance at acquisition because there was no other revaluation for the subsidiary after the date of acquisition. And then we showed these three amounts. Firstly, in the consolidated statement of profit or loss and other comprehensive income, and then in the consolidated statement of changes in equity. However, if this was the official examination paper, you could have just ignored these two amounts because we didn't need to draft the consolidated statement of changes in equity according to our required section. Okay, I am only drafting that statement for the purposes of this lesson. All right. Okay. And then Grazing Ltd did not have a revaluation during the current year, which means that we can take the revaluation surplus balance for the parent, which is 650,000, as the opening balance for the group. Okay, so 650,000 will be the opening balance of the revaluation surplus column for the group. Okay, keep in mind, however, that if there was a revaluation for the subsidiary between acquisition and the beginning of this year, the portion that is allocated to the parent, so this amount right here, would be included in the opening balance calculation. Okay, please take note of that. I have covered such an example in a few lessons that I have posted on Google Classroom. So please go have a look at those lessons. Okay, where there was a revaluation for the subsidiary between acquisition and the beginning of this year. All right, the amount that goes to the parent must be included in the opening balance for revaluation surplus in the consolidated statement of changes in equity. However, in this question, that is not applicable. Alright, so we are done with revaluation surplus. We have calculated the current year's revaluation surplus for the subsidiary. We have showed it in all the applicable or all the relevant consolidated financial statements. And we have determined that the opening balance for revaluation surplus for the group is 650,000, which is the revaluation surplus balance for the parent at year end. Okay, the company did not have a revaluation in the current year. So there was no change in that RVS balance for the current year. Okay, on to additional information point 3. Now, goodwill is disclosed at cost less impairment in the consolidated financial statements in accordance with IFRS. Goodwill was not impaired in the current year. In FAC2602, we do not deal with impairment losses relating to goodwill. So the amount calculated in the analysis of owner's equity, after you have made all necessary adjustments where needed, will be the final amount for goodwill. So goodwill is calculated by taking the consideration received from the parent, which is 1.25 million, that has been given in the trial balance, the investment in Econ Limited, and then we just subtract the parent's share in the ordinary equity at acquisition, which is 1,156,400, which could also be just 70% of 1,652,000. The difference between these two amounts will give you 93,600, which is goodwill, and that only relates to the parent. So there is no portion that is allocated to non-controlling interests. So in the consolidated statement of financial position, we will show goodwill according to calculation 1, because there is only one analysis of owner's equity calculation, as we do not deal with preference shares in this question. The amount for goodwill that we have calculated is 93,600. All right. As I've indicated, and according to additional information point 3, we do not deal with impairment losses relating to goodwill in FAC2602. That again will be dealt with in financial accounting 3. All right. Then let's go to additional information point 4, which says the following. On the 1st of October 2018, Grazing Ltd purchased 2 kinds of industrial butchery equipment, namely Toledo IR230 and Bandsaw 420Y from Econ Ltd. So clearly in additional information point 4, we are dealing with an intergroup sale of depreciable equipment, okay, or depreciable assets, that being the industrial butchery equipment. All right. Now, Toledo IR230 had a carrying amount of 18,700 on the 1st of October 2018, the date of sale, and was bought by Grazing Ltd for 24,200 Rand. Bandsaw 420Y had a carrying amount of 19,650 on the 1st of October 2018 and was bought by Grazing Ltd for 23,650. The group policy provides for straight line depreciation on equipment over 10 years, so that will translate to 10% per annum. So the depreciation is provided for at 10% per annum according to this straight line method. Okay, so let us first make a heading right here. Heading 2.1, intergroup sale. Let us just refer to it as heading 1. The intergroup sale of industrial butchery equipment by Econ Ltd, because Econ Ltd sold the equipment to Grazing Ltd. Alright, now because we are dealing with 2 kinds of equipment, we will split the calculations of the unrealized profit or loss and the unrealized appreciation that is associated with each piece of equipment. However, we first need to take note of the date of sale or the date of the intergroup transaction, which is the 1st of October 2018, which is clearly in the previous financial year. So because this transaction occurred in the previous financial year and not in the current year, we know that we will need to make use of retained earnings in order to eliminate the unrealized profit or loss, as well as the unrealized depreciation for the previous year. Okay, it's very important that you take note of the date of sale, the 1st of October 2018, which is clearly in the previous financial year. So let us address the Toledo IR230 equipment first. So Toledo IR230. Alright, now according to additional information point 4, the carrying amount of this equipment was 18,700 Rand on the date of sale, and the proceeds was 24,200. So there was clearly a profit made on this transaction. And we know that this profit is not realized outside the group, or has not been realized outside the group, because it was gained on an intergroup transaction, so a transaction between two companies in the same group. So because of that, we need to eliminate the unrealized profit for consolidation purposes. So the unrealized profit is equal to the proceeds on the date of sale, which is 24,200, and then we will subtract the carrying value of 18,700. All right. This will give you an unrealized profit of 5,500 Rand. Okay. Let us do all the calculations first, because I have worked through this question previously and there was an unrealized profit for both pieces of equipment, or both kinds of equipment. Okay. So I will first do all the calculations and then we will make the necessary adjustments. So for the first equipment, or the first kind of equipment, there was an unrealized profit of 5,500. Okay, then we need to calculate the unrealized depreciation from the date of sale to the end of the current financial year. And because we are using the straight line method, we can immediately calculate the unrealized depreciation for the entire period. Okay, so unrealized depreciation from the 1st of October 2018 until the 31st of March 2020, which is the end of the current financial year. For this equipment, it will be taking the unrealized profit of 5,500, then we multiply by 1/10 because depreciation is provided for over 10 years, okay, or 10% per annum. So you can replace the 1/10 by 10%. And then we will multiply by 18/12 because we are calculating unrealized depreciation for a total of 18 months, right? This will give you an amount of 825 Rand. So 825 is the total unrealized depreciation that we need to eliminate for this particular equipment. However, for consolidation purposes, we need to split this between the previous period and the current year. So for the previous year, it will be taking the amount of 825 and multiplied by 6/18. In respect of the previous year, this will be 6 months. So from the 1st of October 2018 to the 31st of March 2019, the end of the previous year, it will be a total of 6 months: October, November, December, January, February, and March. Okay, that is why we use 6, and then 18 is used because this amount right here relates to 18 months. Okay, an alternative is taking the unrealized profit of 5,500 multiplied by 10%, and then we will multiply by 6/12. Okay, both of those calculations will give you the same answer. which is 275. And then for the current year, we will take the 825 multiply by 12 over 18 because we are calculating depreciation for 12 months and this amount relates to 18 months. Or we could take the amount for the previous year, multiply by 12 over 6, or we could just multiply that by 2. And the final alternative is taking the unrealized profit of 5,500 and multiply this by 10%. Times 12 over 12, which is just 1. And this will give you 550. So of this amount of 825, which must be eliminated on the Toledo equipment, 275 is in respect of the previous year, and 550 relates to the current year. Okay, as I've said previously, we will finish all our calculations, so let us do the second equipment first, or let us finish the second equipment's calculations, and then we will process the necessary journal entries. Okay, because an unrealized profit was made on both of them, so the journal entry for eliminating the unrealized profit as well as the associated depreciation will be the same for both equipments, or both kinds of equipment. So the bandsaw 420Y. So the unrealized profit is again calculated by taking the proceeds on the date of sale, which it was 23,650, and we will subtract the carrying amount of this equipment, which was 19,650 on the date of sale, and the unrealized profit is therefore 4,000 Rand. Again, because this was made on an intergroup transaction, it has not been realized outside the group, and it needs to be eliminated for consolidation purposes. The total unrealized depreciation is also calculated from the 1st of October 2018 to the 31st of March 2020, just as we have calculated this one. Taking the unrealized profit of 4,000 multiplied by 10% or 1 over 10, and we will multiply by 18 over 12, and this will give you 600 Rand. And again, we need to split this between the previous year and the current year. So 600 times 10% times 6 over 12. Or we can take the amount of 4,000, sorry. Let me just correct this. 4,000. Taking the unrealized profit times 10% times 6 over 12. Or we could just take the unrealized depreciation of 600 Rand multiplied by 6 over 18. Right. This will give you a total of 200 Rand in respect of the previous year. So the current year's amount will be 400. Alright, which we can calculate by taking 600 times 12 over 18. Or we can take the amount for the previous year multiplied by 12 over 6. Or just multiplied by 2. And the final alternative is taking the unrealized profit of 4,000 Rand and multiplied by 10% times 12 over 12, which is just 1. Alright, you will arrive at 600 Rand in total. Okay, the previous year is 200 Rand and 400 Rand relates to the current year. Okay, so we will combine the unrealized profit or profits for the two pieces of equipment, and then we will process a journal entry. So the total unrealized profit that we need to eliminate for consolidation purposes is 4,000 for the second equipment, or for the bandsaw equipment, plus the 5,500 for the Toledo equipment. And this will give you 9,500. So this is the total unrealized profit that we need to eliminate for consolidation purposes. we know that Econ Cows Limited sold the equipment Intergroup. So therefore, Econ Cows Limited, the subsidiary, made the profit in a previous period. So we need to decrease the actual profit made by Econ Cows Limited in the previous year by decreasing their retained earnings account. So therefore, we will debit retained earnings for Econ Cows Limited by 9,500, and we will credit property, plant and equipment, or PPE for short, for Grazing Ltd, because the unrealized profit is included in the carrying value of Grazing Ltd's property, plant and equipment at year end. And the total profit of 9,500 must be eliminated because it has not been realized outside the group. The group cannot gain a profit on a transaction that it concluded with itself. Okay, so this is the elimination of unrealized profit included in Grazing Ltd's property, plant and equipment. All right. Let me just put this in a frame. Let's pick that one. Just make sure that it is still recording. Yes, it is. So in terms of this journal entry, and keep in mind that you do not need to provide the pro forma consolidation journal entries in question 2. Okay, this is only for the purpose of understanding the adjustments that need to be made in terms of this transaction. All right. So in terms of this pro forma consolidation journal entry, we need to debit retained earnings for the subsidiary. And because we are concerned with the subsidiary's retained earnings, we will show this adjustment in the analysis of owner's equity in the since acquisition to the beginning of the current year section. So to the beginning of the current year, 1st of April 2019. All right, before we get to that, we still need to calculate the change in retained earnings since acquisition. So we will take the opening balance, so the balance on the 1st of April 2019, which has been provided in the trial balance for Econ Cows Limited. And that amount is 676,355. So 676,355. And then we will subtract the balance at acquisition, which was given as 452,000. According to additional information point 1. And then we need to account for this journal entry. We need to debit retained earnings for the subsidiary. So we need to show that this is unrealized profit included in Grazing Ltd's property, plant and equipment. And because we are debiting retained earnings, this will be shown as a negative adjustment. Okay, 9,500. Okay, and then for the second part of this journal entry, we need to credit property, plant and equipment for Grazing Ltd. So we will show this in the consolidated statement of financial position. We should start off by writing down or typing in the amounts that have been provided in the trial balances for the two companies. So we will start with land and buildings, 1.25 million plus 2.27 million. Then we have equipment and machinery at cost, 755,450 plus that of the subsidiary, 845,700. However, keep in mind that property, plant and equipment is shown at carrying value in the statement of financial position. So we need to subtract the accumulated depreciation on equipment and machinery. So therefore we have to subtract 285,700 for the parent, 285,700, and we need to subtract 325,300 for the subsidiary. And according to this adjustment, we need to credit property, plant and equipment. So therefore, this will be shown as a negative adjustment. Okay, 9,500, which is the total unrealized profit that is included in the property, plant and equipment of Grazing Ltd. Right. So that is the elimination of the unrealized profit. However, we still need to account for the unrealized depreciation. So the total unrealized depreciation that we need to eliminate for consolidation purposes is 825 for Toledo and 600 for the bandsaw equipment. So this will give you a total of 1,425 Rand. Okay, of which relates to the previous year. We have calculated that 275 plus 200 for the bandsaw equipment. So that makes it 475 in total. And then for the current year, it will be 550 plus the 400 for the second kind of equipment, which gives you 950. All right. So our journal entry will be as follows. Now, because there was an unrealized profit of 9,500 in total, the parent, Grazing Ltd, has provided for too much depreciation in its own financial records. Okay, because of the unrealized profit that was included in its property, plant and equipment carrying value. So therefore, we need to decrease the accumulated depreciation for Grazing Ltd. So in other words, we will debit accumulated depreciation for Grazing Ltd by 1,425, because that is the total unrealized depreciation that we need to eliminate. And then we will credit two separate accounts. Firstly, we will credit retained earnings of the company that made the unrealized profit, which was Econcals Ltd. And the amount credited to retained earnings will be 475, because that is the unrealized depreciation in respect of the previous year. And the second account that will be credited is the depreciation expense, which will form part of other expenses as shown in the trial balances for the two companies. So you can either show that you credit depreciation or other expenses. Also for the company that made the unrealized profit, which is Econcals Ltd, and the amount credited will be 950. All right, this is the elimination of unrealized depreciation from the date of sale to the end of the current year. Okay, let's put this in a frame once again. Okay, so let us address this journal entry. So we need to debit accumulated depreciation for the parent. So by debiting accumulated depreciation, you will actually increase the carrying value of the group's property, plant and equipment. So in the consolidated statement of financial position, this will be shown as a positive adjustment, 1,425, because we are decreasing accumulated depreciation, therefore increasing the carrying value of property, plant and equipment. Then we need to create retained earnings for the subsidiary. Once again, this will be shown in the analysis of owner's equity because it pertains to the subsidiary. So create retained earnings, 475, unrealized depreciation in respect of previous year, or in respect of the previous year, which will be 475. We will show this as a positive adjustment because we are crediting retained earnings according to our journal entry. And then we need to credit depreciation or other expenses. Firstly, we need to show this adjustment in the analysis of owner's equity in the current year section because it affects the subsidiary and it relates to unrealized depreciation. So we need to first show this amount in the current year section as an adjustment against the profit after tax. So unrealized depreciation for current year. Okay, and the amount that we have calculated is 950. Because we are decreasing an expense item, right, by crediting depreciation or other expenses, this will lead to an increase in the profit after tax amount. So therefore, we will show this as a positive adjustment in this section. Because we are decreasing an expense item, therefore increasing the profit after tax. And then the second place where we need to show this amount or adjustment is in the consolidated statement of profit or loss and other comprehensive income, specifically referring to administrative expenses. So we will start with the amounts given in the trial balances for the two companies respectively. So other expenses, 770720, plus the amount for the subsidiary, which is 728680. And because we are crediting other expenses, we will show this as a negative adjustment, 950, according to this journal entry. Okay, we are done with additional information point 4. We have calculated and eliminated the unrealized profit on both the Toledo and bandsaw equipment, and we have eliminated the unrealized depreciation accordingly. Right. Okay, so we are done with additional information point 4, the intergroup sale of equipment, where the subsidiary made the profit. Okay, let's move on to additional information point 5, which addresses the intergroup sales of inventory. So the second one is intergroup sale of inventory. Okay. Now, Econ Cows Limited occupies a large space of land. Just make sure that it is recording. When compared to Grazing Ltd. So therefore, the company purchased cows, which will logically form part of its inventory. That includes livestock. Okay. The company purchased cows from Grazing Ltd at 25% profit markup on cost, which is consistently applied. So in terms of inventory sales between the two companies in the group, it is clear that the parent makes the profit of 25%. So intergroup sales of inventory by Grazing Ltd to Econ Cows Ltd. So Econ Cows Ltd purchases the inventory from Grazing Ltd. Okay, and then the profit markup is 25%. So this will be used as part of the calculation of the unrealized profit amount that is included in opening and closing inventory. Okay, details of the inventory and purchases are as follows. So the first date on which there was intergroup sales of inventory was on the 5th of March 2019, which is clearly in the previous year because the current year started on the 1st of April 2019. Okay, so this was the intergroup sales amount for the previous year, 145,000. Now keep in mind that this amount of 145 would have already been eliminated in the previous year when the group's financial statements were drafted. So we will not say, okay, we are going to debit revenue for Grazing Ltd and credit cost of sales for Econ Cows Ltd by 145,000 because this will already have been eliminated during the previous year. Okay. However, we will use this amount in order to calculate the unrealized profit that is included in Econ Cows Ltd's opening inventory. Okay. But we will not eliminate the intergroup sales for that year because it has already been done during that period. So in respect of this 145, 100% was still on hand on the 31st of March 2019. So at the end of the previous year, the subsidiary Econ Cows Limited had the inventory of 145,000 as part of its closing inventory. Okay, and if that was included in the closing inventory of the previous year, it would have been included in the opening inventory for this year. Okay, so the amount that includes unrealized profit in opening inventory for the subsidiary is 145, because this entire amount was still on hand as at the end of the previous year. So therefore, it was included in Econ Cows Limited's opening inventory, and we know that this amount includes unrealized profit because it was purchased from the parent. And then all this inventory was sold externally in the following year. So this means that there is not a portion of this inventory that is included in closing inventory for this year. Okay, let us address the opening inventory first. Okay, opening inventory. All right, remember, when it comes to intergroup sales of inventory, we need to consider whether there is unrealized profit in opening inventory as well as closing inventory. In this case, there will be unrealized profit in opening inventory because there was an intergroup sale of inventory during the previous year, of which the inventory was still on hand at the beginning of this year. So the unrealized profit that is included in Econ Cows Limited's opening inventory is 145,000 because this is the value that includes unrealized profit. All right, and we will multiply this by 25 over 125, which will give you 29,000. So the unrealized profit amount that is included in opening inventory is 29,000 Rand. So our journal entry is that we need to increase the profit made by the company that sold the inventory. In this case, it was Grazing Ltd. So with the elimination of unrealized profit in opening inventory, okay, we will increase the parent's profit for the current year, okay, by decreasing their cost of sales account. And the elimination will be done against retained earnings of the same company. So therefore, we will debit retained earnings for Grazing Ltd by 29,000, and we will credit cost of sales, as I've just explained, because we are decreasing cost of sales for Grazing Ltd, 29,000. Okay, this is in respect of the unrealized profit in opening inventory. Okay. Elimination of unrealized profit included in Econ Cows Limited's opening inventory. Right, so let's make all the necessary adjustments. So firstly, we need to debit the retained earnings account of the parent. So we will not show this in the analysis of earnings equity because the retained earnings of the subsidiary is not affected. Okay, however, we will do this or make this adjustment in the opening balance calculation of the retained earnings column in the consolidated statement of changes in equity. So you first need to take note of the opening balance for the parent, which has been provided in the trial balance, which is 922,500. That is the opening balance for the parent in respect of retained earnings. And according to this journal entry, we are debiting retained earnings of the parent by 29,000. So we will show this as a negative adjustment as part of the opening balance calculation, which we will get to at the end of this lesson. Or we will do that once we have gone through all the points under additional information. A&E Limited's opening inventory. Right. just make a note there that you need to debit retained earnings for the parent according to that journal entry. And then we need to credit cost of sales for the parent as well. And again, even though it is an unrealized profit that we are eliminating, it does not relate to the subsidiary. So therefore, we will not show this in the analysis of owner's equity. All right, so we will only show it in the consolidated statement of profit or loss and other comprehensive income. First, we need to consider the amounts given in the trial balances. So 1,491,250, okay, plus the amount for the subsidiary, which is 581,040. Okay, and because we are crediting cost of sales, we will show this as a negative adjustment. Minus 29,000. Okay, that is the elimination of unrealized profit in opening inventory. Okay, then we will move on to the current year's intergroup sales of inventory, which took place on the 1st of March 2020. And the amount of intergroup sales for the current year was 287,500. So this is the amount that we need to eliminate for consideration purposes. Okay. Intergroup sales intergroup during the current year, okay, which we need to eliminate for consolidation purposes as well. And this will be done by debiting revenue or sales for Grazing Ltd, because Grazing Ltd has sold the inventory to Econ Cows Ltd. So the amount of 287,500 would be included as part of its revenue for the current year, 287,500, and we will eliminate that against the cost of sales account for Econ Cows Ltd. Okay, this is just the elimination of intergroup sales for the current year. So no unrealized profit that we are eliminating. We are just eliminating common items. So this will be shown in the consolidated statement of profit or loss and other comprehensive income. So we will debit revenue. So let's start with the amounts given in our trial balances. So it will be revenue 3,455,000 for the parent, plus the amount for the subsidiary, which is 2,726,300. And then we are debiting revenue by 287,500 according to our journal entry. Okay, it is still recording. 287,500. And then we need to credit cost of sales for the subsidiary. Once again, it is not an unrealized profit, so therefore it's not shown in the analysis of owner's equity, only in the consolidated statement of profit or loss and other comprehensive income. And because we are crediting cost of sales, we will show this as a negative adjustment, 287,500. Elimination of intergroup sales for the year, or for the current year at least. Okay, then we can move on to closing inventory. Now, first we have to take note of the details provided regarding the current year's intergroup sales, which says the following. So on the 31st of March 2020, so at year end or by year end, 10% of these purchases, so 10% of the 287,500 had not been delivered to Econ Cows Ltd, but ownership had correctly passed. So this is what is known as inventory in transit, which was already recorded by Grazing Ltd as part of its revenue. Okay, they would have recorded the transaction because the ownership has already passed. However, Econ Cows Ltd has not recorded this transaction yet because they have not received the inventory by year end. Okay, so the inventory that is in transit is not part of its closing inventory. Okay, so in terms of the inventory in transit, the value of that inventory is calculated as follows. We will just take the 10% that they have provided in additional information 0.5 and then multiply this by 287,500 because 10% of that value has not been delivered by year end. And this will give you 28,750. Okay, so this is the value of closing inventory, or the value of inventory that is still in transit by year end, but ownership has already passed, so we need to account for an additional entry in the subsidiaries records. I would just like to show you the two different journal entries that were made in Grazing Ltd and Econ Cows Ltd records respectively, or the journal entry that was made in the parent records and the one that we need to make in the subsidiaries records regarding the inventory that is still in transit, that the subsidiary has not yet recorded because it has not been received by year end, but because the ownership has already passed, we need to include it as part of its closing inventory. So Grazing Ltd has already made the following entry. Okay, they have debited trade and other receivables because the inventory is still in transit, which means that the subsidiary has not yet paid for that inventory. So it is still receivable from Econ Cows Ltd. Okay, so they would have increased trade and other receivables, and the reason why we use trade and other receivables is because there is no Intergroup current account that is utilized for Intergroup inventory sales. So if there is no current account between the two companies, we will make use of trade and other receivables or trade and other payables. And they would have credited sales or revenue by the same amount. Okay, once the invoice is settled, they would just credit trade and other receivables and debit their bank account. Okay, but because the inventory is still in transit, we will instead use trade and other receivables. Okay, so this entry has already been made by Grazing Ltd. Okay, we need to account for the entry or the corresponding entry in Econ Cows Ltd's records or Econ Cows Ltd's records. Okay, so this is the adjustment that we need to make, is that we need to debit inventory because the ownership has already passed to Econ Cows Ltd. So therefore we need to include it as part of its closing inventory. So as part of its inventory at the 31st of March 2020, even though the inventory has not been received yet, the ownership has already passed. So we need to increase inventory for Econ Cows Ltd by 28,750, and where we have debited trade and other receivables for the parent, we will credit trade and other payables for the subsidiary because that invoice still needs to be settled with Grazing Ltd. So therefore we will credit trade and other payables with 28,750. Okay, so let us account for this journal entry. So we need to increase inventory for the subsidiary. So in the consolidated statement of financial position, start with the amounts provided, which was or were inventory, livestock, and other, 882,500 for the parent, plus 1,191,250. So 1,191,250. Please make sure that you enter these amounts correctly. And then we are debiting inventory for the subsidiary according to this journal entry that we still need to make. So therefore this will be shown as a positive adjustment. Okay, 28,750. And then the second part of this journal entry is that we need to credit trade and other receivables for the subsidiary. So in your current liability section, start with the amounts given, as 257,300 plus the amount for the subsidiary, which is 445,600. And then we, because we are crediting trade and other payables, it will be shown as a positive adjustment. Okay, 28,750. This journal entry is made for the purpose of accounting for the inventory that is still in transit. Okay, that should have been recorded in the subsidiaries records, but it wasn't because the inventory has not been delivered yet. Normally, they would only include it as part of closing inventory once it has actually been received. But in this case, the ownership has already passed, so we need to account for it as part of closing inventory. Okay. Now, if 10% of the total purchases, which was 287,500, was not delivered by year end, okay, it means that the remaining 90% has been delivered by year end. Okay. So inventory received from Grazing Ltd during the year or by year end is 90% of 287,500. Because if 10% wasn't delivered, it means that the remaining 90% was delivered. Okay. So the inventory that was received by Econcows Limited from the parent was 258,750. And this is very important for the next sentence that I'm about to read. This was the inventory received by year end, and of this consignment that was delivered, 70% was sold to external parties at year end. Okay, 70% of the consignment that was delivered had been sold to external parties at year end. So 70% of this value has been sold at year end, which means that the remaining 30% is part of closing inventory. Okay, because that portion has not been sold by year end. So what this means is, in order for us to calculate the unrealized profit that is in closing inventory, we first need to calculate the value of closing inventory that includes unrealized profit. And that will only be inventory that was purchased from Grazing Ltd, which is still on hand by year end. So closing inventory that includes unrealized profit will be calculated by considering the inventory in transit first, because we need to include it as part of closing inventory. Okay, the ownership has already passed. So we will start with 28,750, and then we need to calculate 30% of this amount right here, because 30% has not been sold to external parties at year end. Okay, only 70% of that consignment has been sold. So 30% remains in closing inventory and includes unrealized profit. All right. So the total value of closing inventory that includes unrealized profit that we need to eliminate for consolidation purposes is 106,375 Rand. Okay, please make sure that you understand the calculations that I've shown. And I've also explained this in the suggested solutions to this question, which is available on the Telegram group. So therefore, the unrealized profit in closing inventory that we need to eliminate for consolidation purposes is 106,375 multiplied by 25 over 125, because the profit markup was 25%, and this value already includes the unrealized profit of 25%, which is why we use 125 as part of the calculation. Okay, this will give you 21,275 Rand. So this is the total unrealized profit in closing inventory that we need to eliminate for consolidation purposes. So when we eliminate this unrealized profit, we need to decrease the actual profit made in the current year by Grazing Ltd because that company sold the inventory into Intergroup, and we will do so by increasing their cost of sales account. So therefore we will debit cost of sales for Grazing Ltd, 21,275, and remember, we are eliminating the unrealized profit, or we are removing the unrealized profit from closing inventory, which is why we will credit inventory for Econ Cows Limited. 21,275. Elimination of unrealized profit in closing inventory. Alright. So let us account for all the necessary adjustments. We have already accounted for the inventory in transit in Econ Cows Limited records. Okay, so we will debit cost of sales for the parent. Even though this is an unrealized profit, it does not relate to the subsidiary, so no adjustment is shown in the analysis of owner's equity, only in the consolidated statement of profit or loss and other comprehensive income. Okay, we are debiting cost of sales, so this will be shown as a positive adjustment. And then we need to credit inventory for Econ Cows Limited in the consolidated statement of financial position. Okay, minus 21,275. Alright, so that is the elimination of unrealized profit in closing inventory. However, we are not completely done with all the necessary adjustments. Apart from eliminating the unrealized profit, we also need to eliminate common items, and that will be these two items right here. The trade and other receivables in the parent's records, which includes 28,750 in terms of the inventory in transit, and the trade and other payables amount in Econ Cows Limited's records. Okay, these are common items that we need to eliminate against each other for consolidation purposes. So we will debit trade and other payables for the subsidiary, and this will only be done after you have made this additional entry. All right. Okay, debit trade and other payables for Econ Cows Limited, 28,750, and we'll credit trade and other receivables for Grazing Limited with the same amount. Elimination of common items, which is the inventory in transit. Okay, so we need to account for this journal entry as well. Okay, so we will debit trade and other payables, so this will be shown as a negative adjustment in this section right here. So in effect, you do not really need to add 28,750 in trade and other payables because it would have been eliminated in any case. All right, I've just shown you for the purpose of understanding the adjustments that needed to be made. Okay, so we will add 28,750 and this just subtract it again because we are eliminating common items. And then we need to credit trade and other receivables for the parent, which already accounted for the inventory in transit. So the amounts reflected in the trial balances for the two companies will be as follows. Trade and other receivables, 330,000, plus the amount for the subsidiary, which is 593,750, and then we are crediting trade and other receivables. Therefore, we will show this as a negative adjustment. Right, that is the elimination of common items, that being the inventory in transit. So we are done with additional information point 5. We have eliminated the unrealized profit in opening inventory. We have eliminated the intergroup sales for the current year. We have accounted for the inventory in transit in the subsidiaries records. And we have eliminated the unrealized profit in closing inventory as well. Okay. And regarding the elimination of the unrealized profit, it is not shown in the analysis of owner's equity because it does not affect the cost of sales account for the subsidiary. Okay, then let's look at the additional information point 6. Now, Econ Cows Limited borrowed 250,000 Rand from Grazing Ltd on the 1st of October 2019, which is clearly within the current financial year. All right. The capital amount of the loan will be repaid over 2 years. So what this means is that the loan itself will not be settled within the next financial year. So in Econ Cows Limited's records, it will be shown as a non-current liability because they need to settle the amount with Grazing Limited. And in Grazing Limited's records, this will be shown as a non-current asset because it is not receivable within the next financial year. Okay. Interest is calculated at 15% per annum and is payable in arrears. So paid at the beginning of each month. The first payment with interest was made on the 31st of March 2020, so at year end, and recorded correctly by both companies. Now, the 6 months interest paid for the year ended 31 March 2020 amounted to 18,750 Rand, which was correctly calculated. However, you can calculate this amount or confirm this amount, or the correctness rather of this amount, by taking the balance of the loan on the 1st of October 2019, which was 250,000. We will multiply this by 15%, which is the interest rate, and then we calculate interest for 6 months. All right, you will arrive at 18,750. So the amount itself was correctly calculated and recorded by both companies. So if we look at our trial balances, okay, Econ Cows Limited would have paid the interest. So therefore, it would be part of its interest expense for the year, and Grazing Limited would have received the interest, which means that it is included in its interest income. All right. In this case, interest income is not part of other income. Okay, interest income has been shown separately. All right. So we need to eliminate the intergroup interest for consolidation purposes. And we will do that as follows. Okay, no calculation is needed because the amount has been provided in additional information point 6. So we need to debit interest income for Grazing Limited by 18,750 or with 18,750, and we need to credit interest expense or finance costs for the subsidiary. 18,750, elimination of intergroup interest for the current year. Okay, remember once again, this journal entry is not necessary. It just helps you to understand the adjustments that need to be made. Okay, now because the interest income and expense are shown separately in the trial balances, we can offset those two items against each other to arrive at a net finance income or net finance costs amount that we will disclose in the consolidated sum of profit or loss and other comprehensive income. In this case, the total interest expense for the group will exceed the interest income for the group, which means that there is a net finance costs amount. All right. So interest income. Oh, let me just correct that. Interest income and interest expense. Okay, so we start with the amounts as given. So interest income was provided as 37,500, and then we need to debit interest income by 18,750, so negative adjustment, and then interest expense amount for the parent is 45,230 plus the amount for the subsidiary 41,850, and then we need to credit interest expense for the subsidiary, so we will show this as a negative adjustment as well. So in terms of additional information point 6, we are mainly interested in the intergroup interest amount that we need to eliminate for consolidation purposes. Right, and these two will be subtracted from one another in order to arrive at net finance costs. We will do that later on. Okay, and if we go to our trial balances, we will see that in Grazing Ltd's records, the loan was disclosed as a non-current asset that I've already explained, amounting to 196,875 because there was a capital repayment at year end. So that would not have affected the calculation of the interest. Okay, 196,875, and in the subsidiaries records, it is disclosed as a non-current liability. The loan from Grazing Ltd 196,875. These two will just be eliminated against each other for consolidation purposes. Right, no adjustment is needed in that regard. All right. Okay, we are done with intergroup interest. No other adjustments that we need to make, so we can move on. We are also done with additional information point 7, which we have addressed in the beginning. So let's move to additional information point 8, which says that the directors and management of EconCals Limited declared a dividend of R1.20 per ordinary share on the 25th of March 2020, so before year end, and it is payable on the 2nd of April 2020. So at year end, those dividends are still payable. The transaction was erroneously omitted in both companies' records, or both companies' accounting records. So what this means is that neither of the two companies accounted for the dividend declared by EconCals Limited. Okay, and because neither of the two companies accounted for that dividend, there is no elimination of an intergroup dividend because the parent has not recorded it as part of its other income. Okay, so therefore we do not need to eliminate the intergroup dividend in the consolidated statement of profit or loss and other comprehensive income. Okay, so if this is the case, all right, where both companies did not account for the dividend that was declared by the subsidiary, okay, we only need to account for the dividends that are payable to non-controlling interests. Okay, please refer back to Learning Units 8 and 9 for more details on this rule. Okay, Learning Unit 8 addresses ordinary dividends, whereas Learning Unit 9 addresses preference dividends. Ordinary dividends payable by EconCals Limited. Okay, as I've said, neither of the two companies accounted for the dividend, so we only need to calculate and account for the dividend that is payable to non-controlling interests. Okay, we have already determined that the NCI has a 30% share in the ordinary share capital of the subsidiary, according to our analysis of owner's equity. The total the dividend declared is R1.20 per ordinary share, and the total dividends, or the total shares rather, that have been issued by the subsidiary is 520,000. Okay, of which 30% is owned by non-controlling interests. So 520 shares So 187,200 is payable to non-controlling interests. So our journal entry in order to account for this one is that we need to debit NCI or non-controlling interest by 187,200 or with 187,200, and we need to credit dividends payable by the group because it has not been paid by year end. 287,200. Accounting for ordinary dividends payable to non-controlling interests. As I've explained, there is no elimination of intergroup dividends because the parent has not included it as part of its other income. And it was not recorded by the subsidiary either. So let us make all the necessary adjustments. So debit NCI in the consolidated statement of changes in equity in the NCI column. Okay, 187,200 is subtracted in that column. And then we need to credit dividends payable, which must be shown separately on the consolidated statement of financial position. Dividends payable by the group, 187,200. Okay. Now, even though we do not need to eliminate the intergroup dividend, we still need to show the total dividends that have been declared by the subsidiary in the analysis of owner's equity. Okay, which will just be 1.2 times 520,000 shares. And we need to show this as a negative amount. So the total dividends declared by the subsidiary is 624, of which 436,800 goes to the parent. However, this was not recorded in its other income. All right, according to additional information point 8. And 187,200 goes to non-controlling interests, which we have already accounted for. All right. Okay, and then we just need to account for the dividends payable, the dividends paid by the parent, which is 28,570. This amount will be shown in full in the consolidated statement of changes in equity in the retained earnings column, where it will be shown as a negative adjustment. Dividends paid by owners of the parent is 28,570, according to the trial balance provided. All right. So we are done with additional information point 8. And then finally, the net profit after tax of the subsidiary in its separate financial records amounts to 1,094,010 Rand for the current financial year. And we need to use this amount or disclose this amount in the analysis of owner's equity in the current year section. So profit after tax as given, 1,094,010. Okay, however, you can confirm the correctness of this amount as follows. You will look at the trial balance for the subsidiary. So we will start with revenue of 2,726,300, add other income of 23,000, subtract cost of sales of 581,040, subtract other expenses of 728,680, minus interest expense of 41,850, and finally, because we want the profit after tax, we need to subtract the income tax expense of 303,720. You should arrive at the amount of 1,094,010. So that amount has been calculated correctly. Okay, we have shown it in the current year section. And then we just need to account for the remaining items in the trial balances. So income tax expense for the group will be 241 5890 plus the amount for the subsidiary 303720. Okay, then we need to account for other income, which is 26250 or 650 rather. Let me just correct that, and then the amount for the subsidiary is 23,000. Okay, then we need to account for the 12% debentures that will be shown as part of non-current liabilities on the consolidated statement of financial position. So 12% debentures, we just correct that. 12% debentures. Amount for the subsidiary, the parent rather, is 385. Damn it. 385 for the parent and 725 for the subsidiary. Okay. Then we have the long-term loan in Grazing Ltd's records. That is not an intergroup loan of 623505. So we will show that as long-term borrowings, 623505. Okay. And then we need to account for cash and cash equivalents in the current assets section. So 135,670 plus the amount for the subsidiary 157,440. Okay, so now we can just finish drafting all the consolidated financial statements. So let us first do the consolidated statement of profit or loss and other comprehensive income. Just copy this. Okay, so this is the amount for revenue for the group, 5,893,800. Then we go to cost of sales, which should be shown as a negative amount because it needs to be subtracted from the revenue amount in order to arrive at the gross profit, which is 4,116,735. Other income would be 49,650. Administrative expenses will be 1,498,450. Okay, then we need to calculate the net finance costs amount. Interest income is 18,750, and interest expense will be shown as a negative amount of 68,330. So the net finance cost for the group is 49,580. Okay, then I just need to adjust my formula. So this will be the profit before tax, 2,618,355. Then we calculate the income tax expense for the group. Which is subtracted from the profit before tax, 545,610. And that will give us a profit for the year of 2,072,745. We have already dealt with the other comprehensive income section. So total comprehensive income for the group is 2,467,745. And then we need to split this between non-controlling interests and owners of the parent. So we will start with non-controlling interest, and these amounts will be found in the analysis of owner's equity after you have made the necessary adjustments regarding unrealized profits or depreciation against the profit after tax. Preference share capital is not applicable in this question. So we will take the profit for the year after adjustments attributable to NCI, which is 328,488. And then we need to add the NCI share in the current year's revaluation surplus, which was 118,500 plus 118,500. Okay, so total comprehensive income attributable to NCI is 446,988, and your owners of the parent will just be the remaining amount. Okay, taking the total comprehensive income for the group and just subtracting the NCI's portion, which should give you 202,0757. All right, we are done with the consolidated statement of profit or loss and other comprehensive income. So we can move to the consolidated statement of changes in equity. Let me just correct this. 31st of March 2020. So opening balances, share capital was 735. We have already determined that. Retained earnings will be the opening balance of the parent, which is 922,500. Then we needed to make the adjustment of 29,000 as part of the elimination of the unrealized profit in opening inventory. And then we need to add this amount right here. The parent's share in the subsidiary's retained earnings since acquisition to the beginning of the current year, which was 157,31. This will give you 10,44231 as the opening balance for the retained earnings column. And then non-controlling interest will be calculated by taking the balance at acquisition and just adding the NCI share since acquisition to the beginning of the current year, which was 64,599. So the opening balance for NCI is 560,199, giving you total equity of 2,989,430. Right, wonderful. Okay, then we move to our total comprehensive income section. So we need to split other comprehensive income and profit for the year. So in terms of the parent's share, the amount that is credited to retained earnings will be this amount right here. The total comprehensive income that is attributable to owners of the parent, 202,0757. And then we need to subtract the other comprehensive income portion of 276,500. Right? So 174,4257 is credited to the retained earnings column. And then your NCI's portion was 328,488. Okay, that is the profit for the year. That is attributable to non-controlling interests. Okay, and please make sure that once you have entered these amounts, that you arrive at the profit for the year for the group, which is 207,745, as disclosed in the consolidated statement of profit or loss and other comprehensive income. So the total comprehensive income for the group should also correspond to this amount, 2,467,745. And we have already dealt with the dividends. Okay, and just for confirmation, the closing balance of non-controlling interests that you have calculated in the analysis of owner's equity. Remember, in this question, there is only one analysis of owner's equity calculation because preference shares were not applicable. So the closing value right here, which is 819,987, should also be the closing balance of the NCI column in the consolidated statement of changes in equity, 19987. Okay, that's just for correctness. And finally, let's finish the consolidated statement of financial position. So property, plant and equipment for the group should be 4,502,075 Rand. Then we need to go to inventories. $2,081,225. Trade and other receivables for the group is 895,000, and then we have cash and cash equivalents of 293,110 Rand. So your total asset section should amount to 7865010. Okay, then we go to our equity and liability section. Share capital according to the consolidated statement of changes in equity, 735. Retained earnings will be 2,759,918. Other components of equity, which will just comprise of revaluation surplus, 926,500, and then non-controlling interests, 819,987, giving you total equity of 5,241,405 for the group. Then we have our non-current liabilities, debentures amounting to 1.11 million. So total non-current liabilities 1,723,505. And then we still need to account for the trade and other payables. Okay, those two will just cancel each other out. Okay, our calculation is a bit off. Okay, let me just see what error I have made. 010 minus 7855010. I'm out with 10,000. Oopsie. That is a problem. Okay, let me just make sure that I've entered everything correctly, because this is the correct amount for the asset section. Let me just go to my set of suggested solutions. Oh, it's this amount right here. I've calculated non-current liabilities incorrectly. Wait. Let me just correct this. Yes, that's our error. Sorry guys, just a simple mathematical error that I've made. I've calculated the sum of these two incorrectly in my head. It's actually 1,733,505. Okay, thereafter the consolidated statement of financial position should be in balance. Okay, total equity and liabilities should also be 7865010. Okay, this then concludes today's lesson. In the next lesson, I will be working through question 3, the statement of cash flows, using the indirect method, because a lot of you have been asking that we work through a statement of cash flows question where we use the indirect method. So that will be covered in our next session. Please keep in mind that you need to pay attention to your required section. For this lesson, yes, I have drafted all 3 statements. However, in the examination, you only need to draft what is stated in the required section. However, because we needed to draft the consolidated statement of financial position in full, by drafting the consolidated statement of changes in equity, we managed to calculate these amounts correctly. Okay. So indirectly, you also needed to draft this statement, because otherwise you could not have drafted this section right here. All right. All right, ladies and gentlemen, good luck with the remainder of your preparation. I'll see you in the next session.